If you're joining a Series A, a Series B, even a Series C company, there's a very good chance that that equity is worthless. And so if you risk balance the value of that equity, it's a perk that is, by and large, worth very, very little. Hey, I'm Alon. I am a finance guy. I've been in finance for over 20 years. I've been CFO, COO in companies like Bring, Seeking Alpha, and Natural Intelligence. And now I am the founder and CEO of Aption, a company that provides equity pooling for founders, senior executives, employees. Equity pooling is a really simple concept. It allows startup founders to get access to the type of economic exposure that VCs have. Instead of being exposed in what is usually a very, very high percent of their net wealth to one company, the company that they work for founded, they can trade part of that for exposure to a basket of similarly promising startups. Startups nowadays take a very, very long time to play out and either die or exit. I think the average time to liquidity is around 16 years at the moment. And so if you're a founder 4, 6, 8, 10 years into your journey, you could have built significant value in the company, and yet you don't really have access to that. You have increasing risk. You've taken, certainly over your journey, below market terms in terms of your personal compensation. And it just allows you to de-risk some of that equity that you've built and protect your own wealth and your family's wealth. Because you could have started a startup at the age of 26 or 28 and you're relatively carefree and at that age, and you've started this company. And then as you're building it, you also get married and you have a family, and suddenly you're 38 and you've been in this business for 10, 11 years, you've taken sub-market terms for a lot of that. And those are really critical years for paying into your 401k, your pension. We all know how compound interest works. And you suddenly pause at 38 and you say, well, what's going on with my long-term financial future and that of my family? And you sort of say, I haven't really done a great job. I've still got this great bet on my startup. I raised the Series C. It might play out, but it might not. There's still a 60, 70, maybe more percent chance it doesn't play out. And so if you Aption part of that, at least you can take $1 million, $500,000, $1.5 million, whatever it is, off the table, put it in something which has a much, much lower risk profile. And then you can say to yourself, okay, at least when I retire and when I need to set my kids up for the future, at least I have something. And it may not be that $4 million that plays out. It might be slightly more. I don't know what return I'm going to get, but it's definitely got a different risk profile to the risk profile I'm holding now in my startup. And we've seen founders feeling a lot better about themselves and their financial future because of that. When we create pools, we pool similarly promising companies. And to do that, we need to get our handle on 3 vectors. One is a capital vector. So what sort of capital has that company raised? At what sort of valuations? That's actually relatively easy to get in terms of public information or certainly parts of it. We try and get a handle on traction. Typically traction is a combination of revenue growth and some interaction with efficiency, so either net dollar retention or growth burn ratios, things like that. That is typically non-public data. It's very hard to get your hands on, and we try and get an idea of scale. Is this company with 3 customers and $200,000 of ARR, or is this a $100 million business? Again, slightly harder to get our hands on. We can get our hands on an awful lot of other data. Reviews, customers that have publicly put their name against in case studies or reviews somewhere, employee numbers, how employee numbers are trending up or down, employees by departments. Are they hiring more sales? Are they not hiring more sales? We have a few different mechanisms. Some of the pools actually manage themselves and they vote in companies as the pools grow and expand. We also have built a tech platform which is based on lots of data that we buy, that we scrape, that we collect, and an algorithm and AI that sits on top of that and maps companies across three vectors: across traction, across scale, and across capital characteristics, and clusters companies with other companies that more or less line up in terms of those three vectors. In terms of volatility, so venture equity is probably the most volatile asset class on the planet. From funding, a startup has around a 7-8% chance of actually seeing a liquidity or meaningful liquidity event that will return money to ordinary shareholders. Part of that is because the pref stack wipes out certain exit events, but also it's just an intrinsically risky asset class. These companies start from nothing. There's market share to gain. There's traction to be got, and all of that is done under funding. And if anything slips up along the way, then the company goes to zero. So by taking a basket of that, you inherently reduce volatility significantly. Liquidity is similar. When you hold one position, you're tied to one liquidity event. When you hold 15, 20 positions, you're tied to 15 or 20 potential liquidity events. And so if any of those go before your liquidity event, you'll have access to liquidity earlier. In terms of success stories, one success story I can think of is one of the earlier pools that we had. We had an equity holder in Ametic. Ametic was very publicly bought out by Tenable for a all-cash transaction, and the money that came in, the equity that had been pooled within that position of Ametic, got shared out across about 9 people who were with that individual in the pool, and everyone got some early access to liquidity. And there's still a whole bunch of other great positions in that pool, and so they have more chips on the table, and hopefully we'll see more liquidity events down the line. We've spent a lot of time speaking to investors. We've spoken to probably close to a couple of hundred VCs, and we have some regular check-ins with some of the bigger VC players, mainly because it's really important for us to be good actors and be net ecosystem positive. There's been a range of responses. I think the most common response by far is, so long as the founders are only doing this to a certain percentage of their holding, typically we hear sort of the 10% of their holding number is a number that VCs tend to be comfortable with, then this seems fine to us. Some VCs are interested in creating these pools across their portfolios so that their own founders can access that VC's track record, which is a cool use of the platform and something that we hadn't really envisaged when we set out on this. There are some VCs that are a little bit more hesitant. They're trying to get their heads around their differences between equity pooling and secondary, and how do they think about the interaction between the two, or one versus the other. There are some VCs who have been doing the same thing for the last 30, 40, 50 years, and anything new is scary, and there's some caution towards, but by and large, we've been very, very positively surprised by how the VC community has looked at this stuff.